Welcome to this week's market drama. We'll start with the markets. S&P 500 was up 2.6% for the week. That makes it 14.8% year to date. NASDAQ was up even more, up 3.2% last week, makes it 30% up for the year. That's 5 weeks in a row in which stocks have been up. And this is mostly in the back of the Federal Reserve meeting on Wednesday, in which they agreed to not hike interest rates. They pause. And in the press release, there were definitely comments that could both support accommodative Federal Reserve or a more hawkish Federal Reserve. So on the more accommodative side, Powell stressed repeatedly that the policy committee has not made any decisions about raising interest rates any further. And he used phrases such as, we move much closer to our destination. We, might have been sufficiently restrictive when it comes to interest rates. He also said words like, we're getting closer to being in balance, right? So the markets read that as, okay, we're there, or we're almost there. And in fact, a lot of the gains seen during the week were after the press release. So that's essentially the accommodative comments. Now, there were also comments made that the markets didn't quite listen as much, but the Federal Reserve Chairman Powell also mentioned that it might take a couple of years before they start actually lowering interest rates, right? He said, hey, look, we want to keep real interest rates positive. So sure, if inflation gets to a much lower destination now, we'll lower interest rates. But he said that might take a couple of years, right? So I think that the market is kind of listening to what it wants to listen here. Nonetheless, there's no doubt that the economy has held up better than a lot of people anticipated, which does give credence to the fact that, for instance, consumer services stocks, consumer discretionary stocks are the ones leading the way outside of technology stocks, which is more of like the AI story. When it comes to economic data points, we did see the producer price index decline month over month, 0.3%. That's 4 declines over the last 6 months. PPI tends to lead CPI, so that is a positive indicator that CPI will continue to come down. Core inflation fell to its lowest level since November 2021. Nonetheless, it is not coming down as fast as headline CPI, which is more volatile and driven by energy prices, for instance, and food prices. So core CPI still, above 5%. So long way to go for core CPI to get below 3%, but nonetheless moving in the right direction. Something to keep in mind that I found really interesting as to why the economy has been more resilient than expected is that when you look at households' savings, the extra savings that we saw during COVID are still very much kind of working their way through the system. So there was actually a white paper written by the Federal Reserve. Apollo kind of did a deeper dive as well on this based on that paper. And they found that households are running down their excess savings, but there's still about 1.2 trillion of those excess savings. So in essence, that's why consumer spending has been so resilient to the fact that the economy is slowing down, that we still are working through those excess savings, which could mean that the economy could just be a lot more resilient in this business cycle than maybe in past ones. Next week, we have Chairman Powell testifying in the House on Wednesday and the Senate on Thursday. So no doubt we're going to get some headline comments coming out of that. And we also have flash US PMI for both manufacturing and services on Friday. That will give you another kind of glimpse of how the economy is holding up so far. That's it for us this week. Stay tuned for next week.